Assalamualaikum warahmatullahi wabarakatuh.
Hi, good people!
In this video, we will explain about financial statements. We will divide it into three groups that will explain three categories of financial statements.
First group will explain about the income statement. The second group will explain about the owner's equity. And the third group, will explain about the balance sheet.
So, enjoy!
This is the trial balance that we use to make financial statements.
The first group will explain about income statement.
What does financial statement mean? Financial statements are the main source of financial information for most decision makers. That is why financial accounting and reporting place such a high emphasis on the accuracy, reliability, and relevance of the information on this financial statement. Definition of income statement. The income statement is also known as the statement of operation, profit and loss statement, and a statement of earnings. It is one of a company's main financial statements. The purpose of the income statement is to report a summary of the company's revenues, expense, gains, losses, and the resulting net income to occur during a year, quarter, or the period of time. Items appearing in income statement. First, revenues, which are the amounts earned through the sale of goods and or providing service. 2. Expenses, which include the cost of goods sold, SGA expenses, and interest expenses. 3. Gains and losses, such as the sale of a non-current asset for an amount that is different from its book value. 4. Net income, which is the result of subtracting the company's expenses and losses from the company's revenues and gains. Corporation with shares of common stock that are publicly traded often refer to net income as earnings, and their income statements must include the earnings per share of common stock.
From the existing trial balance, we will make an income statement.
The second group will explain about owner's equity.
Statement of owner's capital. A statement of owner's equity shows the change in the capital according to contribution, withdrawals, and net income or net loss. This change includes capital in beginning or rated earning in beginning, drawings or dividend, profit or loss come from income statement. It is often used by mostly large business as most small business report their retained earnings or on their balance sheet. If you do need to prepare one, it is usually prepared after the income statement because the net income or net loss for the period must be reported on this statement. Similarly, it is prepared before the balance sheet, since the owner's equity at the end of the period must be reported on the balance sheet. Because of this, the statement of owner's equity is often viewed as the connection link between the income statement and balance sheet.
What is the statement of owner equity used for? This statement can show the financial health of a business and whether the business has sufficient cash flow to fund its own operation without the aid of outside investment. In the exception of a business that is quietly growing and the owners have to invest capital to fund additional inventory, account receivable, wages, etc. If a business is unable to show it could financially support itself without capital infusion from the owner, creditor would be unlikely to loan the business money. How do you calculate the statement of owner's equity? The statement of owner's equity is commonly calculated by referring to the balance sheet and income statement during a specific period of the time. The income statement provides information about the net income or losses of the business, while the balance sheet will provide the information regarding owner contribution and draws. To calculate the statement, the beginning balance is needed to start and is obtained from the previous period ending equity balance. Income and owner contribution are added to beginning balance total, while business losses and owner draws are subtracted. The sum is the ending equity balance. This is the form of owner's equity. First, beginning of equity balance. Second, plus income earned. Third, minus owner draws. Fourth, equals ending equity balance.
This is one calculation that many small business owners overlook as they don't understand the value of monitoring it to asset change over time.
The last group will explain about balance sheet.
Okay, now we're gonna learn about the balance sheet. My friends will explain about the definition of balance sheet.
The balance sheet, a summary of the company position on one day at a certain point in time. The balance sheet lists the asset, liabilities, and owner's equity on one specific date. In a sense, the balance sheet is a picture of the company on that period. Investors and creditors can use the balance sheet to analyze how companies are funding capital asset and operation as well as current investor information. This is valuable information to the banker who wants to determine whether or not a company qualifies for additional credit or loans. Others who would be interested in the balance sheet include current investors, potential investors, company management, suppliers, some customers, competitors, government agencies, and labor unions. Assets. Assets are things that the company owns. They are the research of the company that have been acquired through transaction and have future economic value that can be measured and expressed in dollars. Assets also include costs paid in advance that have not yet expired, such as prepaid advertising, prepaid insurance, prepaid legal fees, and prepaid rent. Examples of asset accounts that are reported on a company balance sheet include cash, account receivable, inventory, supplies. Examples of contra asset accounts include accumulated depreciation building, accumulated depreciation equipment. Classification of assets on the balance sheet. Accountants usually prepare classified balance sheet. Classified means that the balance sheet accounts are presented in distinct groupings, categories, or classification. The asset classification and the order of appearance on the balance sheet are current assets, investment, property, plant and equipment, intangible assets, other assets.
Liabilities. Liabilities are obligations of the company. They are amounts owed to creditors for a past transaction, and they usually have the word payable in their accounts title. Along with owner's equity, liabilities can be towed as a source of the company's assets. They can also be towed as a claim against a company assets. The creditors or suppliers have a claim against the company's assets, and the owner can claim what remains after the accounts payable have been paid. Liabilities also include amounts received in advance for future services. Since the amount received recorded as the asset cash has not yet been earned, the company defers the reporting of revenues and instead reports a liability such as unearned revenues or customers' deposits. The example of liability accounts is notes payable, accounts payable, expense payable, and the classification of liabilities on the balance sheet is short-term liabilities and long-term liabilities. Owner's equity can be thought of as source of a company assets. Owner's equity is sometimes deferred to us the book value of the company, because owner's equity is equal to the reported asset amounts minus the reported liabilities amount. Owner's equity may also be referred to as the residual of assets minus liabilities. These references make sense if you think of the basic accounting equation. Assets equal liabilities plus equities, or equities equal assets minus liabilities.
This is the balance sheet.
Alright, that's all the explanation. Wassalamualaikum warahmatullahi wabarakatuh.
Goodbye, good people.